Let me ask you a question. If a company is great, amazing product, strong brand, talented leadership, does that automatically make it a great investment? Most people assume the answer is yes. And that assumption is one of the most expensive mistakes investors make. Because here's the truth. A good company is not always a good investment. And sometimes a boring or even average company can be an incredible investment. Today, we're going to break down the critical difference between a good company and a good investment, why even professional investors get this wrong, and how you can avoid it, whether you're just starting out or have been investing for years. What is a good company? Let's start with what most people focus on first, the company itself. A good company usually has things like strong brand recognition, a product people love, competitive advantages or a moat, talented management, growing revenues, positive public perception. Think of companies like Apple, Google, Nike, or Tesla. These are real businesses creating real value in the world. They innovate. They grow. They matter. And here's the key point. A good company is defined by how well it runs its business, not by how its stock performs. This is where most investors stop thinking and where the real problem begins. What is a good investment? Now let's talk about something very different, a good investment. A good investment is not about how impressive the company is. A good investment is about what you're paying versus what you're getting. In simple terms, a good investment offers a high probability of attractive returns relative to its risk. That depends on things like valuation, expected future cash flows, growth assumptions, risk, market expectations. Here's the uncomfortable truth. You can buy an amazing company and still make a terrible investment. Why? Because investing is not about the company, it's about the price. The price versus value problem. Let's use an analogy. Imagine a beautiful house. Great neighborhood. Perfect condition. Exactly what you want. If it's priced at $300,000, it might be a fantastic deal. If it's priced at $3 million. Same house. Same quality. Terrible investment. The stock market works the same way. When you buy a stock, you're not buying the company, you're buying it at a specific price, with specific expectations already baked in. Many great companies trade at prices that assume years of perfect execution, continuous high growth, no competition, no economic downturns. When expectations are that high, even good news can cause the stock to fall. That's how investors lose money in great companies. Why great companies can be bad investments. Let's talk about why this happens so often. A few reasons. 1. Overvaluation. If a stock is priced for perfection, there's no margin for error. 2. Narrative investing. People fall in love with stories, not numbers. Familiarity bias. We like companies we use and recognize. Media hype. Popular stocks attract more buyers, driving prices beyond fundamentals. This is why some of the best-known companies in the world have produced long periods of poor returns, even while the business itself performed well. Can a bad company be a good investment? Now here's where it gets interesting. Can a company with problems, slow growth, bad, or a boring business still be a great investment? Yes. Because investing is about expectations. If the market expects a company to fail and it merely survives or improves slightly, the stock can perform extremely well. This is why average companies bought at great prices often outperform great companies bought at terrible prices. This doesn't mean you should buy junk. It means you should separate business quality from investment opportunity. How smart investors think differently. Experienced investors ask different questions. Instead of, "Is this a great company?" they ask, "What is the market already assuming? How much growth is priced in? What would need to go wrong for me to lose money? What would need to go right for me to make money?" They focus on expectations versus reality. That's where returns come from. So here's the big takeaway. A good company creates value. A good investment captures value. They are related, but they are not the same. If you remember just one thing from this video, let it be this. The best investment opportunities often appear when great companies are misunderstood and disappear when great companies are universally loved. If this helped you think differently about investing, hit the like button, subscribe for more deep dive investing content, and let me know in the comments. What's a great company you think might actually be a bad investment right now? See you in the next one.